Welcome to the Opening Bell Report.
Today, we're diving into a high-octane equity research report on Rezolve AI, ticker RZLV. It's making a really bold call for a 300+% upside to about $11, all banking on a huge Microsoft partnership.
Let's get right into it.
Okay, so a key theme running through this whole analysis is the heavy reliance on the valuation gap between Rezolve's roughly 3x forward price-to-sales ratio and its peers, who are trading at, what, 18x?
Right, and that's, I think, the first big hurdle. The report lays out this massive gap, it looks great in the chart, and basically says, look, this is mispriced.
An obvious opportunity.
An obvious opportunity. But the weakness is that the analysis treats this gap as an automatic buy signal. It doesn't really interrogate why the market is pricing this thing at penny stock levels.
It's assuming the market is just irrational.
Exactly. It frames the discount as a mistake, an oversight, instead of a calculated risk assessment by investors who are absolutely terrified of the spank curse.
Yeah, it's like saying this house is cheap, but you haven't checked for cracks in the foundation. As a reader, I know about the de-SPAC history, so what's the move here? How do you make this stronger?
Well, the suggestion is to explicitly dismantle the fears that are driving that discount. Don't just point out that the discount exists. The analysis has to prove the market is wrong, not just that the market is low.
So attack the SPAC curse head on.
Attack it head on. You have to show why Rezolve is the exception to the rule that, 90% of these things fail?
Okay, I see that. So let's talk concrete examples. What does that look like in the report?
Okay, so instead of just a table showing Rezolve at 3x sales and, say, SoundHound at 18x, you need to contrast their cash positions or their operating histories. You have to explain why the peers get that premium. Acknowledge the fear.
Got it.
And look, the report mentions a V-shaped recovery, a rounding bottom breakout. Don't just leave that as a technical note.
Frame it.
Yes, argue that this breakout is the market finally pricing in the Microsoft deal, that it's the signal that the SPAC volatility is ending.
Ah, that's a great angle. It changes the narrative from the market is dumb to the market is finally waking up.
Precisely. And there's one piece of data in here that's just criminally underutilized.
The Cohen & Co. accumulation?
The Cohen & Co. data. It says institutional investors are buying. Don't just list that fact. Use it. Use that data to prove that smart money has stopped treating this like a failed SPAC.
So it becomes a behavioral argument, not just a mathematical one.
That's it. It validates the idea that the 3x multiple is an opportunity, not a trap. It's much more persuasive than just pointing at a spreadsheet.
Makes a lot of sense. Okay, let's move on. Let's look at the financial projections, specifically that revenue growth.
The numbers are, they're eye-popping.
They really are. The projected leap from about $5.3 million in revenue to $350 million in 2026 is, a 6,500% growth rate. But the bridge between those two numbers feels a little thin.
A little thin is generous, and that's the weakness. I mean, the report cites guidance and the Microsoft deal, but it completely glosses over the operational nightmare of scaling that fast.
Right.
To any skeptical reader, this just looks like magic math. It's the kind of over-optimistic modeling you see in reports for companies that, end up going to zero. It feels aspirational.
It's a destination without a map. We see the $350 million peak, but we don't see the climbing gear. So how do we build that bridge?
The suggestion is to break that number down. Break down the $350 million into tangible pipelines, into unit economics that come directly from that Microsoft co-sell agreement. We have to make the hypergrowth feel mathematically inevitable.
Okay, so let's get granular. What does that look like on the page?
Well, the report mentions a $130 million go-to-market commitment from Microsoft. That's a huge number, but right now it's just floating there.
It's an abstract.
It's an abstract. You need to explicitly calculate how much of the $350 million target is covered by that specific commitment. Is it 30%? 50? Show the math. If Microsoft is putting $130 million into the channel, what's the expected return on that?
That grounds the big number in a real contract. It stops being management hopes and becomes Microsoft pays.
Exactly. And then do the same for the brain commerce tech. The report mentions H&M, Ferrero. Okay, so detail the conversion assumptions. How many retailers of that size need to adopt the brainpower LLM to get to that $500 million ARR exit run rate?
So you're framing the $350 million not just as guidance,
but as the natural output of the Microsoft sales machine. That's the key. Microsoft has thousands of sales reps. If they're paid to sell Rezolve, you can model that, show the inputs, X salespeople selling to Y retailers at Z price point, and the output of $350 million stops looking like a guess.
It becomes a calculation. That transforms the whole section from a wish list into an actual business plan.
And that's what separates a research report from a puff piece. You give the reader the tools to audit your logic.
I see what you're going for. Okay, let's pivot to risk. The argument here, as I see it, is that while the report acknowledges the high cash burn, what is it, negative $40 million a quarter?
Something like that, yeah.
And it acknowledges dilution is likely, but it fails to mathematically integrate that risk into the final $11.65 price target.
This is probably the single most critical flaw in the entire analysis. The weakness is this huge disconnect between the financial section, which admits they need cash and have less than $20 million,
Right.
and the forecast section, which just slaps a sales multiple on to get to a $3.5 billion market cap. It treats dilution like a side note. Risk, dilution likely. That's not good enough.
It's not just a risk, it's a variable. If you change the share count, you change the price per share. It's like calculating your slice of the pie without knowing how many people are at the table.
You said it perfectly. And any sophisticated reader knows this. If you're predicting a huge price target, but you just ignore how the company's going to fund itself to get there, you lose all credibility.
So what's the suggestion?
You have to stress test the $11 thesis. Model the dilution directly. Don't hide from it. Show that even with a significant share issuance, the upside is still attractive.
That would build a lot of trust. So how would you actually show that?
You run a bear case dilution scenario. You calculate it. You say, look, if RZLV issues, say, 50 million new shares to cover the burn until they break even in late 26.
Does the price target drop to $9?
Maybe it does. And then you argue that $9 is still a massive upside from where it is today. See, showing that math proves the thesis is robust. It shows you're not wearing rose-colored glasses.
That's a really strong point. It actually makes the bull case stronger by acknowledging the cost. It answers the reader's first question before they can even ask it.
Right. And you can also argue that the Microsoft deal might reduce their customer acquisition costs, their CAC. If Microsoft's team is selling for them, maybe the burn rate drops faster than the historical data suggests. But you have to make that case. You can't just hope the reader figures it out.
That connects the partnership right back to the financials. I like that.
It does. And honestly, if a report promises me 300% upside, my first thought is, what's the catch? If the report says the catch is 20% dilution, but you still make 250%, I'm listening.
That makes sense. Okay, let's hit our final point, which is about the overall tone. The report integrates short-term technical analysis, the $2.50 breakout, with a long-term fundamental thesis for 2026. And it creates a little friction.
A little friction is a good way to put it. It feels like it has a split personality. The weakness is really in that actionable insights section. 1 second it's talking to day traders, buy the breakout, watch the 200-day moving average.
And the next it's for long-term investors, wait for Q4 earnings.
Right. It confuses the narrative. Is this a trade or is this an investment? Who is this for?
So it dilutes the focus. If I'm a long-term holder aiming for $11, I don't really care about a 20-cent resistance level. So how do we unify these two voices?
The suggestion is to frame the technicals specifically as validation of the fundamental thesis. Don't present them as two different strategies.
They're courses in the same meal.
I like that, exactly. So for example, instead of just listing $3.07 as a resistance level, frame the breakout above $2.50 as the market's specific reaction to that new $350 million guidance. The price action's confirming the story.
So the chart becomes the visual proof of the narrative.
Yes. And describe that rounding bottom, not just as a pattern on a chart, but as the visual representation of the company's pivot from build to scale. It's the picture of the business turning the corner.
That ties it all together beautifully. It makes the chart relevant to the fundamental investor.
And in your conclusion, you can still have that aggressive versus conservative split. That's fine. But you explicitly state that the technical breakout is the early entry ticket to that long-term $11 destination. The chart is the timing mechanism for the fundamental thesis.
The fundamentals say where we're going, the technicals say when to get on the train.
That's a perfect way to put it. It makes the whole report feel cohesive, like a single unified argument, which is what institutional readers want to see.
This has been a really productive breakdown. We've covered the valuation gap, the revenue model, the dilution, and the overall tone.
We have. And I want to say, the core thesis here is fascinating. This high-risk, high-reward setup with the Microsoft deal is legitimate. It just needs that extra layer of stress testing to convince an audience that's, frankly, been burned by SPACs before.
So, to recap the main points for our listener, first, on the valuation gap, you need to stop asking why is it cheap and start answering why the market's fears are wrong.
Right. Use that Cohen & Co data. Show the smart money is moving in. Deconstruct the SPAC curse.
Second, that 6,500% revenue jump needs a granular bridge. Use the Microsoft pipeline data to build it. Make the $350 million feel like a calculation, not a guess.
Turn the magic math into mechanics. Show your work.
Third, and this is crucial, stress test that price target against the dilution. Model it. Show that even in a bear case for share issuance, the upside is still huge.
It builds so much trust, it turns a sales pitch into a real analysis.
And finally, unify the tone. Use the technical chart to validate the fundamental story. Make the chart the visual evidence of the business pivot.
If the author can do those 4 things, this report goes from an interesting speculation to a serious institutional-grade thesis. All the pieces are there.
Absolutely. I completely agree. To the writer of this report, you have a really compelling story with Rezolve AI. We'd love to see you refine the analysis, especially that revenue bridge and the dilution modeling, and submit it back to us. Once that math is battle-tested, this could be a standout piece.
Absolutely. I really want to see the V2 on this.
Don't forget to like, share, and subscribe for more.